Let's talk more about whether the market is pricing in an earnings season filled with if-onlys. Joining us on the Fast Line Bespoke Investment Group co-founder Paul Hickey. Paul, great to have you with us for this topic in particular. How are you seeing the setup into earnings season at this point?
I mean, I think you guys have all touched on it pretty well here. You look at where expectations are in this earnings season versus the last 5 earnings seasons. Analyst revisions heading into this earnings season are pretty much evenly split between upward and downward revisions. So it's all about, as we all know, it's all about expectations. And just using a football analogy, the Chiefs are 2-3, the Giants are 1-4. I would say Chiefs fans are feeling a lot worse right now than Giant fans are, because the expectations for the Chiefs were much higher coming into this season versus the Giants, and so it sets the stage for more disappointment. And coming to these headwinds, supply chain and labor shortages, and whether or not they're priced in. If you look at Google search trends of how often supply chain and the term labor shortages are being searched, they're at record highs going back to 2004. So, I mean, if searches for these terms are at record highs, you've got to hope that analysts have priced it in by this point, or have ratcheted in their numbers. And I think what we've seen in the revisions trends is that they have been taking this into account, which will make the bar a lot more manageable this earnings season than in earnings seasons over the past few quarters.
Are there some sectors, Paul, where you take a look at the particular sector and think, you know what, maybe it's not priced in, or maybe the revisions haven't hit the sector enough so that it is in fact priced in?
Yeah, so what we look at on an individual sector basis, the energy sector right now, the trend in revisions is the most positive of any sector by a mile. And so when you look at prior earnings seasons where you've seen similar levels of trends and revisions to the upside, the energy sector during that earnings season has average declines, with declines during earnings season more than half of the time. So again, there's the real world example of expectations and then how they're met by the market once the reports come out. Then you can look on the other side of the extreme. You have materials where we've seen a heavy bias towards downward revisions heading into this earnings season. And what we've seen when you see revisions trends this negative or more negative heading into the earnings reporting period, the sector tends to do pretty well during earnings season with gains more than 3/4 of the time. So again, there the bar is set low. And just as far as the broader market and how we're going to see reactions to earnings this earnings season, we have had some companies report already. So we've had about 50 companies in the S&P 1500 report earnings over the last month. And on the day of these companies reported, on average, they've seen a modest gain in reaction to their earnings, with gains about half of the time. So it's nothing real positive, but it's nothing negative either. So it's more of a draw. And since those companies have reported, we've seen similar reactions in the stock. So like not just the one day, but from the time they reported until now, returns are about flat. So again, there's really not that much of a shock on the part of investors at this point to the earnings coming in. And at the top of the show, you mentioned Nike, and talk about company facing all the headwinds of commodity inflation, supply chain disruptions, and labor shortages. That stock dropped over 6% on the day it reported earnings, and because of these headwinds, it's already erased more than 2/3 of that decline from that initial day. Wow. So investors have come in and stepped into it, and I think that somewhat bodes well, and that people are expecting these comments to come up.
Just quickly, Paul, I noticed on the graphic that we showed the audience that upward revisions to financials were up, and I'm wondering how you think that sets us up for tomorrow. We are on the eve of a huge deluge of financials earnings tomorrow.
Yeah, so the financials are an interesting story because they tend to react horribly on the day they report earnings. JP Morgan, this was the 5th straight quarter it's been down in reaction to earnings. Bank of America has been down 7 past earnings reports on the day it reported earnings. Citigroup down 6 in a row. So short term, they've been very negative. But if you look at all those stocks over that period, they've all done pretty well. So while the market sold the news, then people stepped in shortly thereafter.
All right, Paul, great to speak with you. Thanks for phoning in.
You too, thanks.
Paul Hickey of Bespoke. Pete Najarian, what do you think of those sectors that Paul mentioned?
Yeah, I think it's pretty interesting, Mel. I mean, you know, when you look at who's going to get affected most, obviously there are certain names that absolutely come up. You look at Nike and look at some of these names of who's really under the most pressure. When I look at some of the financials, that's a different type of pressure that they're under, and obviously they've been dealing with this for a really long period of time now. So I would expect the numbers to look great. We saw the J.P. Morgan numbers. They were fine. It was just a matter, in my opinion, of where was J.P. Morgan in terms of where the stock was trading versus the rest of the financial world. And that trades at a very expensive valuation. When I say that, I mean price to book. So I see that as a little bit of a headway, but I think there's a lot of these other names that trade very, very inexpensively. Bank of America, Citi, some of those names where I think they do have the ability to maybe give a great number and actually move to the upside.